I ask everyone to hold their answers to the panel's question to the end, and let's use this time to set up the reasoning for your answer. First, I would like to start with Faisal. As CEO of Kamco Invest, how do you see the Gulf region's competitive position evolving, particularly given the current economic landscape?
Yeah. I think if you look at the numbers and statistics in general, you will see that as part of the emerging market, the region is increasingly an important component. Now, this is something that has led to the growth of asset management industry in the region, led to the growth of the economies in the region. A key component, of course, is general stability. I think we've had a very stable region, stable currency, stable economic environment in many ways. Certain parts growing faster than other parts, but continuously growing. And I think that stability has helped a lot in attracting investor interest. And if you look at, for example, the capital markets in the last 9 months and beyond, you'll see that there was a lot of net inflows into the region reflecting that. A lot of entries into the region in Saudi Arabia, in the UAE, Qatar, Kuwait. So a lot of asset managers relocating, coming in, a lot of wealth managers setting up. So the environment in the region has been increasingly attractive for investors from the region to the region and globally as well.
Now going to the second question of what sectors we see in the next, let's say, year or two that would be attractive, I would love to say in technology, for example, deep tech, robotics, renewable energies, and all of the blockchain and the crypto, but I don't think the region is yet ready for startups to be built from the region in those fields. So I would again go back and say the sectors that I would prefer to invest in, and I'm already investing in, are basically fintech and the subsectors of fintech, SaaS, so software as a service, and their subsectors, and also logistics and supply chain, where I see a lot of inefficiencies, and there is a lot of opportunities that can be built by solving those inefficiencies.
So how do you balance the traditional assets with high risk, high reward opportunities, especially when you're considering Gulf-based startups?
I think balancing the, let's say, traditional assets with highly risk MENA startups, again, it involves diversification and selecting the sectors. But again, I mean, at the end, when you look at the markets and what happened, even in developed markets, if we don't invest in MENA technologies today, and we continue to invest in companies that we're familiar with or business models that we're familiar with, in the next 5 to 10 years, we will look back and we will realize that we've missed out on the most promising companies in the MENA. Yes? So as an example, in the States, for example, there's a lot of investors who missed out on Amazon, Apple, Google, and the reason is they haven't seen the potential in those emerging companies at that time. So similar to the States, investing in early stage investments today in the MENA, basically it could mean that you're capturing the future giants of the MENA economy. So I hope I've answered your question.
Yes. Faisal, with Kamco's focus on investment management, what asset classes are your clients leaning towards today in response to current market challenges, and how might that shift over the next year?
Well, one thing at Kamco is that we're focused on 3 core markets. So we have Kuwait, Saudi Arabia, and UAE, and we have a pulse on all 3 and how the environment is evolving there. Now, you have to keep in mind that in the past 2 years, we've had a high interest rate environment and coming into a lower interest rate environment right now. During this period, what we saw with a lot of the clients is a focus towards more income yielding and more distribution investments. So if the investments are distributing or yielding income, there was a preference on that. We also saw, of course, a shift towards cash, more with the concerns that have happened post-COVID. I think more and more investors were wary. Interest rate environment caused this realization that is it worth investing at maybe 200 basis points, 300 basis points with a risk rather than just keeping a deposit in the bank. Now, the interesting thing is if you look at data over 10, 15, 20 years, when we talk about the question of the $100, you will see that the changes over those years are kind of position changes, given the environment that we're in. So the past 2 years, you'd see a lot more cash being kept and more into income yielding type investment opportunities. Increasingly so, the alternatives space is growing. I think in the past year and maybe a little bit longer, and I think in the near future you'll see more and more alternative investment growth, which was growing at a high rate generally. And I think regionally speaking, you still, of course, traditionally speaking in the region, we're talking about real estate, equities have always dominated the region. Now, more and more instruments are coming out around those, so we're pleased to see that. Still, if we look, we're very active in the debt capital markets, for example, as lead manager, and in the primary and secondary side of the debt. We see also a lot of potential there for growth, and I think this is another area that we'll see more and more in the coming period. So in essence, asset allocation in the region, I think, whether you have your cash equivalent, then you go up the risk profile, you have what you have all around the world, right? You have investors that are diversifying. And the interesting part, which I maybe forgot to mention in the first question you had about the region, is that it's also a diversifying economy. If you look at the GCC region as one economy, or economies that are focusing on how to diversify away from oil and how to grow and achieve that objective. And with that, with international asset managers coming in, you will see more and more sophistication coming into the region. So we're pleased to see that the asset management space is growing. And keep in mind, we still don't have funded indemnities. We don't have a lot of structures that I think in time will come.
Stefan, within the same context, what trends are you seeing among institutional investors and their asset allocation preferences? Are there alternative assets gaining traction with your clients? Are they looking somewhere new to invest?
Yes. So to the question of how would you invest $100, it really depends who you are and what your objectives are. And this is also how we work in terms of our risk analysis and then our sort of access and platform, how we fill the buckets. So if you are an individual, it's different than a family, than a company. Then obviously if you're more in the endowment space, a foundation, a university, or even a sovereign wealth fund. And what's common in all of that your strategic asset allocation, so how you design the size of these buckets is, and that's proven scientifically, it's 90% of the outcome. So this is really crucial that you have that right and that you stick to it. And then it's a question of how do you fill those buckets. And we talked about diversification, and I think diversification is one thing, but then it's having the access, really having the access to the best managers. It's both on the liquid side, but especially on the alternative side. If you look at performance in the alternative, I mean private equity, private credit, hedge funds, it's really the top 25% that have all the performance. The rest you can neglect. So how do I get access to that? How do you get access? You need research and due diligence capabilities. But not just at the point of investment, you need that also as a maintenance during the time of investment, because things can go wrong, etc. So I think this is very important to understand and to follow. And I think if you have this approach, you also have the discipline to stay through cycles. It's important to stick to this plan, to stick to your asset allocation during difficult times and not change it. And this really will bring you to your outcome, how you want to invest those $100.
So from an international wealth management perspective, what are some strategic considerations for private investors co-investing in or competing in sovereign wealth funds?
Sorry, can you say again?
So from an international wealth management perspective, what are some strategic considerations for private investors co-investing or competing with sovereign wealth funds?
Yes, thank you. So we see more and more what we call an endowment mindset within also families. What do we mean with that? So there was a fund manager at Yale Endowment University. So the Yale University had an endowment. His name was David Swenson, and he found out that basically using his fee budget, the fees he wants to pay out, and minimalize that towards sort of the liquid part. So, i.e., you go to the ETF market, either passive or active ETFs, but really minimizing your fees there and then allocating your fee budget towards alternatives. So the Yale University, who had over the last 30, 40 years an incredible performance, has about 60 to 70% of its asset allocation in alternatives. Now, that's not for everybody because that obviously is an evergreen fund. However, Yale also has to have an income. They have costs, so they need to plan for having a certain income in that as well. So you need a blend also of stable investments that give you income. So this endowment mindset we see more and more with family, and how does this relate now to sovereign wealth funds? We see in the region families using the scale and the access of sovereign wealth funds to invest together. So first of all, obviously the sovereign wealth funds, they're visited more by certain financial providers with more opportunities. But then families have certain know-how that they can provide that the sovereign wealth fund doesn't have. And we see this coming together, which I think is a mutual benefit and alignment of interest. What are the risks? Obviously, sovereign wealth fund ultimately has a different risk tolerance. It's for the common good versus for individuals. And then you have obviously a corporate governance issue as well, in terms of the power of your negotiation. But I think it's a very good thing. It goes with this endowment mindset that we see really globally in Asia, in Europe, in the US, and we see it here also more in the region.
Okay. Hasan, do sovereign wealth fund strategies influence your investment approach in Gulf startups?
I think it's very important to mention. So sovereign wealth funds played an instrumental role in building the foundation for VC investments in the region. Their funding was able to really ignite, let's say, the ecosystem, enable funding for startups who were in a way suffering before 2018. They were able to also attract VC funds that are international to come and set up office in the region. They were able to fund newly established or emerging fund managers in the region, and today we have a number of those who are also very successful. That money, and it's a big amount of money that was invested by PIFs, Jeddah, SVC, Mubadala, ISSF in Jordan, Al-Waha from Bahrain, but those invested big amounts, and those amounts went to really good talent, and that basically attracted talent from outside of the region to come and live in the region and build their ambitions in the region. So I think sovereign wealth funds played a big role in building where we are, taking us to where we are today. Now, the risk that we're facing today, or basically the ecosystem is facing today, is you have few numbers of sovereign wealth funds. And a lot of them are mandated, so they all have national mandates to build their own economy. So you see them, in a way, competing against each other. And that will, in a way, affect negatively the fund managers, because it would not be purely a commercial agreement between them. They will have a lot of different factors they need to meet as fund managers to be able to get those funding. And because the number of sovereign wealth funds is limited, if one changes its mandate or if one decides not to invest in VC anymore, you will see funding levels go down. And that's what happened in the last couple of years. So we're at a stage where, okay, we will hopefully see some IPOs coming soon in the next couple of years. The cycle should be completed within the next couple of years. But if sovereign wealth funds pull out today, I don't think we're ready to complete the cycle without them.
Yeah. So I want to move on to risk-adjusted returns. And this is a question for, I would like all three of you to give me some insights on. So in a volatile global economy, where do you see the risk today for fresh capital? And where do you see the most promising reward based on sectors or geography? And I would like to know your insights on that. Let's start with you, Hasan.
So historically, in volatile markets, down, let's say, markets that are not, or economies that were, at a time where the markets are not doing well, I think this is the best time to invest. A lot of the investments that have yielded high returns have been made in downtimes. So, example, Airbnb, WhatsApp, Uber, all have been created in 2008 in the wake of the financial crisis. In the recent pandemic in the 2020, Zoom Communications and a lot of e-commerce players have thrived basically in that specific time. So again, I think these are examples of companies that have done very well in tough times. So my answer to you is diversifying your portfolio, utilizing the resources of experts and people who have the network to target sectors and geographies that will allow you to mitigate the volatility and manage the risk.
Yeah. Stefan?
Yes, so we see a lot of demand and interest, and that also reflects our pipeline in technology there, especially in artificial intelligence. So for instance, we're raising money for a company now that comes from the quantum computing side, but combines that with SaaS, with AI software to not only disrupt software or media, but also things like pharma or materials. So that is obviously highly interesting. It's very highly valued. It's really about having access and making your bets in that sector. And that, I want to say also with these direct investments, it really comes down to, also sizing the opportunities and how you invest in them and spread and diversify. Yeah, because it's hard to see where obviously AI, where it goes, but there are some leaders emerging clearly. You know, look at OpenAI, this company that we are promoting, because quantum computing will be very relevant to scale AI. Because power, the power that the data centers need is ultimately finite. You see the deals that Microsoft trying to do with nuclear reactors, and it's not that easy to actually get there. So quantum computing combined with AI, this is for instance something. But let's say more mundane subjects. Luxury is a topic that our clients are looking for to invest, and where we see a lot of opportunities. For instance, we have an M&A transaction in the region in jewelry. But also luxury and hospitality, things that we see where we have a lot of dialogue. Sports. So you may have seen that in the US, private equity is now allowed to invest in sports teams. And this has led to a big revaluation of these sports teams. And previous owners who bought these teams 20 years ago are now thinking about selling. So, for instance, we have transactions in the NBA, in the basketball side in the US that we're currently leading. But then it's really also energy, which is very relevant for the region, and energy transition, both in terms of technology, but also obviously transport. So electronic vehicles is very relevant also on our side. So I think these are the sectors we're very busy, and that's both on the direct investment side, but also on the fund side. Yeah, I haven't mentioned one sector, which is healthcare, which is obviously very hard to do diligence on your own. We have some family offices also in the region that have hired doctors and really experts in that field, but that's quite rare. So, so we, for instance, we put in a new private equity fund that J.P. Morgan launched that will be very active in Abu Dhabi, locally with clinical trials, where we have joint ventures. So healthcare is obviously also a very important sector. Yeah.
Faisal, I'd love to hear your opinion.
Yeah, I think, if you look at the global side, you're talking about an ever-evolving market with the different dynamics, whether it's geopolitics, environment, etc. If I was to maybe touch upon the region, I would say, there's more opportunity on the defensive sectors in the region. If you look at healthcare, education was mentioned earlier on. These are sectors that require more and more investment. Investment, of course, will include technology investment, will include all sorts of investments that enhance the economy, because that will be an integral part of the economy. You also see the infrastructure side still continuing ongoing development, and I think despite the fact that we will hear and we have today some of the most sophisticated infrastructures in the world, still more can be done as we move along. And I think hospitality, and we've seen that growing from one country into more countries in the region, that hospitality needs to be there. Of course, with more stability in the region, hopefully end of wars as soon as possible regionally, I think that will add an injection into the stability and growth and investing into the region. Risk, again, is always measured and remeasured at all times, and products come about with a different environment.
So if we're looking at the title of this panel, the $100, where would you deploy them and how would you, and obviously your reasoning behind it?
I think Stefan mentioned something very important. We do have democratization of investment. So as more technology comes into the space, more ability for investors to go as low, maybe not as low as a single $100. But if we look at the $100 as a percentage component and say where we are, depending on our wealth, in the financial world, you break down between retail all the way to ultra high net worth and sovereign. But if you take the general sense, if you have an amount of money today, I think having a good amount of cash is still a reasonable thing, maybe 20 to 30%, depending on how you look at it, cash and cash equivalents. And then how you look at the investments, of course, it's always with investors, as mentioned, the top decile companies perform well, but there is a plethora of others that do not. So you have the access through trusted entities that you can work with, and those entities do a lot of due diligence for you, work, and their reputation is on the line. So having advisors help you manage your money, grow your money is critical. So I would always advise that give us your $100 and we'll manage it for you. The second thing is, I think, yes, it has to be diversified in an intelligent way, given the amount and given the situation you're in, with the requirements that you have. So it's not as simple as, we need to sit with you more to know where the $100 can go.
I was trying to look for justification. What do you think, Stefan?
So if you look at, let's say, outside the GCC, on average, what a large family office has in terms of an asset allocation, it's sort of 25, 30% in equities, 20% in fixed income, 25% alternatives. Then it's 10%, 5-10% cash, and then the difference is gold, is real estate, is infrastructure, sometimes even crypto. Yeah, I think where the region differs is that you have a higher percentage of real estate for Sharia considerations as well to replace fixed income. But in principle, it's quite similar. And where would I invest the $100? I think it's along those lines. It really depends on what your objectives are, how much time you have to reach these objectives. But what I come back with, what we see all the time, and it doesn't matter if it's a family in Kuwait or in New Jersey or in Hong Kong, is about this discipline, especially as a family or as not just one individual, to have an investment policy which keeps you together in tough times when you have to stick to this allocation, and really having this advice from the start to be diversified, because it's not just these large buckets, it's then within the buckets, because sizing within the buckets is also very important. So many banks have this sort of core satellite approach, and what we see often is, so we talk about ESG later, investors want to invest in ESG, but there isn't that much liquid, so you go more into directs, and suddenly the satellite becomes a bit the core, yeah. And this is also what we see, and what you want to avoid. So really building out this core, and then have the themes that you have an interest in, and that obviously promise a lot of performance. That's how I would, in general, answer that question.
And Hasan?
So I stick with the $100 as a number. And initially, when I was thinking about how to answer this question, I thought, you know what, simply ETFs get 9% yearly, long-term investment. But then I thought, you know what, your background is venture capital. You speak to a lot of startups who are creative. You need to be a little bit more creative. So I thought, if I want to, so at the heart of my strategy, there is something that costs nothing, but it's absolutely priceless, and it's basically the drive and the passion that the founder has. And I think when you have the passion, when you're fueled with your passion, no budget is too small. So the $100 can do a lot, and it can be a stepping stone towards building something that is real, that is hopefully a successful business in the future. And I think you have a good experience in that. So the way I would deploy my $100 is to, first of all, think about or brainstorm what am I passionate about. So if I'm a designer, I might have sketched a nice dress or a nice suit. Or if I'm let's say an artist, and I have a nice painting that I've worked on, I would use the first $30 to build a nice content, or a sample of the product, which I will use to market, and then I will use the second $30 to establish or set up my online presence through Shopify or through Wix or even Instagram. And then I will use my third $30 to do targeted marketing using Facebook or Instagram. And then I'll keep $10 for any unexpected costs. And any sale I do will come back to the company. And I bet you that this investment will make 10 times what an ETF would give you.
Interesting. In closing, Stefan, I have a question for you. Given the current US elections outcome, how will this result reflect on the global and Gulf market? And did you make any changes in your allocations since the results?
Yeah. So I think one really differentiating thing that Trump had in his policy was around crypto. So let's see how this plays out. I mean, the current head of the SEC was very much against it in his actions and policies. This could be completely new, and nobody knows what this is going to mean. There's a lot of talk about deregulation that is obviously beneficial for banks like us at the moment, but again, we need to see. I think very important is that he wants to keep the tax cuts. So if you buy, let's say, a share of a company, you're obviously buying the earnings in the future minus the tax. So if the tax is lower, your share price is higher. So that, I think, is a bit what we've seen in the last week. He obviously has the House and the Senate now as well on his side. So it could be that for the next 2 years, we see this direction. But often you have midterm elections in 2 years that change the House and the Senate, and then it's not so easy to do those things. So we will need to see what happens in the next 2 years, but obviously tax, deregulation, potentially crypto could be quite impactful.
Wonderful. Well, thank you for all of you for being here. It's been a pleasure, and I'm sure your insightful strategies on this allocation is going to resonate with some. So thank you very much for being here.
Thank you very much.